All right, if everybody can get a seat, and we'll try to get started. My name is Randall Stevens. I think I know most of you. We started this lecture series, I think this is our fourth one. So it continues to grow each month. We do a monthly on the first Wednesday of the month at 6 o'clock. And we've had it here the last two. This is our second time here. Yeah. And unfortunately, the library only lets you have this facility 6 times a year, so I'm going to try to see if we can work our way. Anyway, we'll continue to try to have them down here. I think it's a great spot for us to do. We've still got a few seats so we can continue to grow a bit. For those of you that haven't been here, the lectures, it's called Startup Advantage, and what we're trying to do is to put together topics that are interesting and appropriate for people starting companies, kind of in that young startup phase of their operations, and all the things that are associated with that. And it takes a little bit different mindset when you're starting this, especially you'll see a lot of tech theme and a lot of the things that are going on here. This is all part of a group called IN2LEX, IN2LEX, which group of us, Ben Askren is our fearless leader of IN2LEX. We've started this group a couple of years ago, and this is just one segment of that we've started, this Startup Advantage lecture series. So just a couple of quick announcements. We have next month Kelly Sloan, who's actually here. There she is in the back. Kelly's our speaker next month, January 5th, I think. It's the first Wednesday. And then in February, if you all were here at the last lecture, Jim Clifton gave a talk on business models versus business plans. In February, we're actually going to try to do a little business model workshop where during this time we'll actually kind of split into groups and work on running through a business model. I've actually started a new software company earlier this year called Pundit. It's some video technology, and we're going to use Pundit as the kind of guinea pig to let people run through this business model exercise and look at different ways. And hopefully I'll benefit by somebody figuring out what I should do with it. So we'll do that in February, and then trying to get March lined up. And then in April, I'm actually working on trying, we did IN2LEX last year, did this, or earlier this year, the April Is, which was a whole series of events during the month of April that were promoted under the umbrella of IN2LEX, which were a lot of, the Creative City Summit was going on here in town, and the TEDx event, and a lot of other, there was actually 30-some events that we promoted during the month of April. That's going on again. We're starting that planning for April. For the lecture that month, I want to try to maybe put together either a half-day or a full-day workshop and try to kind of take this concept and put together a whole day kind of event. So anybody has any suggestions for people that might be good speakers for that, I'm going to try to need to start rounding them up now, but that's what we'll try to do getting started for April. So with that being said, I'll get off the stage. Tonight's speaker is Paul Sullivan. Paul, I met actually through Jim Clifton. He came to the first lecture, which I gave, and made his way through that. So we've gotten together a couple times and shared a couple beers since then, and gotten to know Paul. He's been in Lexington for 5 years now, originally from Calgary, but he's had several companies over his career, from startups to one that actually went public back in 2004 or 5 time frame. I'm sure he'll talk a little more about that. So he's had a lot of experience in different kind of stages of companies and the financing, so he's agreed to kind of lead the discussion tonight on all the different options you have for financing your startup. So everybody welcome Paul Sullivan.
Thanks, Randall. Let me know if you can't hear me. I prefer to sort of walk around a little bit and address everybody rather than stand behind the podium.
Can you move the podium to the side?
I can try. Maybe why? It actually even looks like it's not moving.
Logistics first.
Stay on.
Good.
I've already achieved more than I set out to do. A couple disclaimers. I'll have a few during the during the discussion, but the first is I'm using a brand new technology, brand new for me. It's called Prezi. So for those of you that are familiar with it, it is a online tool. You can use it offline, but really is meant to be an online tool. It takes a really different approach to presentation technology and just trying to wean myself off of the Microsoft reliance that many of us old school folks have developed. So let me know whether you think it's a useful tool or not. You're the guinea pigs. So the discussion is going to be really about venture funding, you know, what you like and don't like about it. A number of things that I put down here that I want to cover, and I'll walk through them and give you an opportunity then to let me know whether there's something else you'd like to see discussed tonight. First, a little bit about me and why I'm standing here instead of one of you. A few things that I'd rather not talk about because either I'm not qualified or you really should get paid to share that kind of information. It's really that I'm not good at certain things, so I'm not going to share things that I don't know a whole lot about. A little bit of common language. One of the things Jim has really impressed upon me is the fact that people come from different environments here, and it is really important to start to establish a common language or terminology. So we'll start with a few definitions and conversations about that. And then I thought I'd run through different types of funding and try to put them in context. Because again, I expect people in the room are going to come from different backgrounds, have different types of startups in mind, and be at different stages. And my belief is that you really need to understand the matching between where you are, your situation, and the kind of funding that's available. And now I'm going to talk a little bit about, I guess, my viewpoint on where funding is going, because there's some big changes underway right now, and we'll talk about those and what the implications are. And then maybe it's just a few hands-on mechanics in terms of what's it take to actually raise the money, and you know, what are the steps I need to follow, what do I need to prepare, and what do I need to be ready for. And then my 2 cents worth, and as Randall said, I'm Canadian, so at yesterday's exchange rate, that's my 2 cents in Canadian dollars. And I'm going to close with a bit of a bibliography on source information, because there's a lot of great information out there, far more than you're going to get from me. All right, so my name is Paul Sullivan. Most people that have been around me long enough would recognize me as Sully. They see me online as Sully, that sort of thing. And yes, I am Canadian. I had the Molson Canadian thing up there, but I thought that was overkill, so I put the Olympic buttons up. I've been around technology a long time. In fact, when I grew up with technology, computers were forklifted into computer rooms, and it took weeks or months to set up. The starting price was certainly in the hundreds of thousands of dollars, and a lot of the equipment I sold when I first came out of university was in the millions of dollars. And it was a great learning. Although the joke that I still remember is, what's the difference between a car salesman and a computer salesman? A car salesman knows when he's lying. And that, to me, is something that's really sort of stuck, and is probably still the case. I did a bit of a transition from technology in the late 80s. I joined Deloitte & Touche, went back and got an MBA, learned a little bit about the consulting business. I became the marketing director for 13 offices across Western Canada. Got quite an exposure to both the consulting side on technology and also the delivery of services. And in fact, my MBA was in entrepreneurship, so along with a buddy, we decided to start our own consulting company, and we called it Notable. It wasn't really all that notable, but it was a consulting company around Lotus Notes. My first venture started bootstrapped just amongst ourselves, 3 guys with a good idea, a couple of prospective clients already in the hopper. They said, if you jump ship, we'll give you a little bit of business to get you going. We built it from 1994 to about 1998, to a point where we had about 35 people, offices in 3 cities in Canada, and some great clients like Disney Studios and National Semiconductor and Royal Bank of Canada. It was a really sort of sterling group of clients. And it was a great lifestyle, but it was a lifestyle business. And for those of you that are in the consulting space, you'll understand that. I mean, it could be relatively lucrative. The challenge is it doesn't scale. You know, if you want to grow, you just add bodies. And if you want to sell the company, it really is typically a multiple of the revenue that those bodies can deliver, right? So our thought was, well, we're starting to build these applications that have some commonality over and over again. Why don't we build products instead of consulting? So my first exposure into fundraising, we had a great little lifestyle business going, but our thought was, well, we're going to have to take half of our consultants and turn them into full-time programmers, get out in front of these products, build the products, and then we'll go out and sell them. Well, in order to do that, we got to finance that. So I went out looking for capital, and this was the late 90s, 98, 99. And actually the industry was pretty hot at the time. So without very much difficulty, I went out and raised about $900,000 from a single high net worth individual who was in the computer business, in the technology space. Was the CEO of a relatively large Montreal-based public company in the technology space. And he wrote a check for $900,000 and said, but we want half of your company. So it was, like I say, my first exposure to fundraising, both in terms of trying to get the money and then understand the objectives of the investors. So $900,000 was a lot of money. We looked at it and said, we think it could be really successful. So we took the money, gave up 50% of the company. And I will say his terms were any significant investments we had to make, anything over $50,000, $40,000, whatever the right number was, required his signature on the check. Beyond that, we just simply put together a business plan, ran it, gave him reporting every month, and never talked to him. He was a great sort of silent partner, opened a few doors for us, gave us support when we asked, but on the other hand, he wasn't in there trying to control our business. We continued to grow the business, and then in early 2000, we had an opportunity to sell the company. If you remember back, around that time, the bubble was just starting, to burst. For us, it was a public company. They were willing to offer a relatively large multiple for what we thought the company was worth. Their offer was a check this size and some cash. Well, our investor now raised his head and said, I want the cash. You guys can take the shares. That's okay. The market's going like this. It's a public company. We took the shares. He took the cash. He was happy. He got his original investment plus a small stipend out of the deal. And we got shares in a public company that immediately fell off the cliff and went from, I think the price at the time was $2.30 to about 20 cents in a period of about 12 weeks. So my second learning was take care of yourself, because your investors will always take care of themselves. So that was notable. After licking my wounds and getting out of that business, the VC market actually came calling for me. And there was a company in Calgary called Guestech that had been venture capital backed. They had raised about $6 million to date. By the time they invited me over to talk to them, they were doing about $1.5 million in revenue and losing about $3 million a year. So about a $4.5 million burn on $1.5 million in revenue. VC said they didn't want to put any more money into it, and knowing where I came from, accountants, sharp pencils, said turn it around. So I did. We went from 30 employees to about 10 very quickly.